So yesterday we had an interview with one of the biggest asset management firms, and they said they might potentially see a hike in interest rates if they lower interest rates too fast. So that eventually would lead to a hike in interest rates. Do you see that as a possibility?
I think particularly in the US economy, we see interest rates coming down, maybe as early as now in December. And I think most forecasters see interest rates coming down. Now, there are some markets where we may see interest rates rise. Japan has been under discussion for rate hikes. But overall, in many economies, I expect next year we'll see lower interest rates, and that should be very beneficial to the markets, and in particular, the credit markets. It will be reflected in the GCC because most of our economies here are pegged to the US dollar. So we should see lower interest rates. But I think the interest rate lowering will be measured, and I think it's been well telegraphed and well forecast. But still, it will provide an economic positive backdrop, and from that, we'll see continued growth in the GCC and particularly in the UAE. I think most are forecasting between 1 and 3 times for next year. But I think just the important thing is stability around interest rates. We had a period after COVID when rates went up quite sharply. We're now on a trajectory where rates are coming down. And our clients, whether it be investors, financial institutions, or corporates, like stability around the interest rate backdrop. And that is very beneficial for economic growth and for investment plans.
And what do you see are the financing priorities across the Asia, Middle East, Africa corridor?
I think 2026 is going to be a super exciting year for investment, and it'll be continuation of the themes that we've seen in the past couple of years. Notably is the infrastructure space, and we've seen infrastructure merge with other asset classes. Of course, data centers and AI is a big component of that. We'll see investment in transportation and logistics. I think we'll see continued material investment into power globally. That will be both renewable and other sources. Asia and the Middle East have very similar investment patterns, but also some differing patterns. But for both regions, we are very positive to 2026.
So Saudi Arabia is seeing a lot of giga and mega projects happening, but there's also a liquidity crunch. How do you assess potentially the FDI and liquidity situation in Saudi Arabia in 2026?
We think that growth in Saudi Arabia is going to continue to be strong. As you said, there are a lot of investment projects, particularly around the infrastructure space, which will continue. There has been some tightening of liquidity, but we also see that as an opportunity. The tightening of domestic liquidity will bring in international FDI and international investors into the banking system. So we think that the flows will be strong into the kingdom and expect a very solid year of investment flows. I think FDI into Saudi Arabia is going to continue to increase. I think you also need to put it as a percentage or ratio. We're talking very significant amounts due to the size of the economy and the expansion plan and the very solid growth that's already been seen. We think that's going to continue, and I think it's really exciting what they're doing around the infrastructure. Investment into infrastructure, but whether it be Saudi Arabia, UAE, or the GCC, has been a core driver for many decades. We've not seen that in other economies, and now they are feeling the negative impacts around that. So investing into infrastructure, logistics, ports, airports, data centers, roads, communication is actually fundamental to growing your economy.
And where do you see the role of Gulf sovereign wealth funds in all of that?
I think it's a really interesting environment around investment currently. We are seeing a team approach to investing in bigger projects. So sovereign wealth funds are combining with banks and other financial institutions, global asset managers, and collectively everyone is investing together. What's been interesting the last couple of years is also the capital structure is being divided up or tranched in order to fit the right investment profile and risk appetite of each investor. So the team approach and collaboration around funding of major projects, from sovereign wealth funds to banks, asset managers, all the way through to private capital, is a really impressive collaboration. And that's driven some of the very significant financings we've seen the last few years.
And private credit, where do you see it heading? Do you see it expanding still at the same rate it is expanding today?
We think private credit is going to continue to grow. It's an increasingly large market potential. We think there's a lot of opportunity around private credit. In the private credit space, which is maybe a little bit misunderstood, a lot of private credit remains investment grade rated, so it's not all high yield rated. We think private credit fills in as a complementary additional capital piece into the capital structure where banks banks or other investors may not have the appropriate amount of capital or the appetite. So we think private capital is here to stay. We think it's very exciting. I'm sure on the private credit journey we'll have some ups and downs like we do in any asset class or investment opportunity, but we believe it's going to be continue to see very strong growth in the coming years.